Hello, today I'm going to talk about a balance sheet, what a balance sheet is and why you need it. A balance sheet is basically a report card on your business. It is done monthly, quarterly, annually. It's a snapshot of where your business is at a particular point in time. Let's talk about what goes into a balance sheet. A balance sheet has assets and it has liabilities and equity. And those two things should equal out when you're done doing your balance sheet. So assets equal liabilities plus equity. Let's begin with the assets. There are two different kinds of assets. There are current assets and fixed assets. A current asset are things like cash in your checking account, cash on hand, any accounts receivable. Accounts receivable is something that you've done for someone else but have yet to be paid. Inventory. Inventory is the amount of goods or products you have in your possession. Could be finished goods or raw inventory. Prepaid expenses are things you have paid for but have not yet utilized. For example, if you paid for a year's worth of insurance but are only 3 months into the year, you have 9 months of prepaid expenses. And then short-term investments. Things like you bought a CD because you had some extra, you have a CD because you have extra cash, things of that nature. Those things all together go into your current assets, which become your total current assets. Then you have fixed assets. And fixed assets are like long-term investments. You have a 5-year program on your website and you have spent the money for that. That has some value. Property, plant, and equipment. That's your physical space, the physical things you need to produce or make your products, and the equipment necessary to do so. Those things have certain life cycles and you depreciate them depending on how long you've had them. So you reduce your property, plant, and equipment by the accumulated depreciation on each of those things. And then you have intangible assets, things that make your business special to you, things like goodwill, things like proprietary ideas, equipment, or vision. Those are intangible assets. Those things all add up to be your total assets. And then you have to talk about how you pay for all those assets or what you have going that you have to pay for in order to make those assets real. You have current liabilities, what you have had done but have not yet paid for. Those are called accounts payable. Any short-term loans, loans that are less than a year long that you have outstanding that you use to pay for your equipment or anything else. Income taxes that you have accrued yet not paid. For example, if you've got a payroll that you have paid quarterly, but it's only 2 months in, that's an accrued income tax. And salaries and wages, all the things that go along with it. You've had people working, but you haven't paid them quite yet. Unearned revenue is revenue for things that you have yet to get paid for. So it's a liability. It's something you have earned, but you've not provided the product yet. And then you have your current portion of long-term debt. That's this year's portion of your long-term debt. For example, a mortgage or a 5-year car loan or a 10-year equipment loan, things of that nature. Those are all your current liabilities. Then you have long-term liabilities, that mortgage, that term loan for the equipment, the term loan for the car. Those are all your long-term debt. Any deferred income tax. That is the difference between what your accountant or what your accounting software does and what your tax liability is. And then any other long-term liabilities. Maybe you are paying the previous owner of the business that you purchased you paid for his goodwill, so you have a long-term liability for that. Those things, plus what you invested in the business, what you paid for the business if you bought it, or what you have invested in the business if you created it. And then any earnings that you have retained, which means earnings you have kept and put back into the business to grow it. Those two things are your total equity, and the equity plus your long-term and current liabilities should equal your assets, and that's a balance sheet. That should come out to a zero balance. The front end and the back end balance each other out, hence the word balance sheet. Your lenders, your suppliers, your bankers, and you are going to want to know this snapshot, this report card of your business on that monthly, quarterly, or annual return. You're going to know where you are. You compare the previous balance sheet to the current one. Am I improving or are we getting worse? Am I making more money or am I making less money? Do I have more cash? Am I okay? Can I move forward? Can I borrow some more money? Or am I tapped out? I have no ability left to do that. That's what a balance sheet does. And that's what your suppliers, bankers, lenders want to see. Where is your business? That's all there is to a balance sheet. It's something that should be done regularly. And when you have it, you're able to move your business forward. One more thing to talk about, a little different thing, is a W-9 form. The W-9 form is a form that you give to your employer if you're a contract 1099 employer, so they have your EIN number to report the income they're going to pay you for the goods, services, and labor that you provide to them. So a W-9 needs to be filled out so that the government knows what kind of income you're getting. If you have any other questions, please visit our website. Thank you so much for listening.